have a quick Q&A. I'll pause the recording as well. So today we're really going to be talking about capital investments. And so what are capital investments? Before we dive into the slides, the big piece we want to take away is decision making. So we're going to be talking about how do we make decisions related to cash. And the problem with cash is all of us don't have unlimited amounts of cash. If you do, please call me. I would love to get to know you better. Maybe you could share some of your limited cash. But we all have a limited amount of cash. Businesses are the same. Even when you get to big businesses like Google, Facebook, some of the companies that I've worked with, they still have a limited amount of cash resources and have to decide with those cash resources, how do you invest them and how are you going to get your best return for the investment? There's a lot into that decision-making process from strategic standpoints, from brand standpoints, marketing standpoints. I'm not going to talk about all of that today. We're specifically going to talk about how do we look at it just from a profitability standpoint. And so some of these big things, if you ever watch Shark Tank, we're going to be talking about today are like internal rate of return. My favorite is net present value. Net present value is extremely useful. It's also known as the discounted cash flows method. We're also going to talk about some simplified methods, also back of the napkin methods that are quick calculations in order to determine payback periods and accounting rates of return. You can use this methodology for anything in life, from determining your retirement, determining your portfolio, buying a house, deciding to rent or buy a car or lease or buy a car. All of this information can be from capital investments. So let's dive straight into it. So what is capital budgeting? So capital budgeting is the process of what I just talked about. We use our limited funds to determine alternative investments. So as a business, I can decide to expand a division, or I could decide to buy stock, or I could decide to start a new division, or I could even decide to pay out my owners and liquidate, right? So out of all these decisions, we have to determine what do we want to buy, what do we want to sell. And so part of the process, if we're talking about specific departments, the department or plant manager will submit proposals related to what they want to buy. And then the capital budget, there'll be a committee on capital budgets who will then debate all of the different plant managers' proposals and see what is the best. And then ultimately a board of directors, if it's a large buy, will approve such an expenditure. And so this is a traditional process. It's different from company to company. Every company will have a different structuring, but this is a pretty traditional process of, if we're going to make a large proposal to spend money, it'll come from some kind of manager. The manager will bring it up to a committee, which will then propose it to the board of directors or to an executive. Most companies will have policies on what dollar thresholds. Like if it's your department might be able to spend up to $10,000, but if it goes to $1 million, it needs to go up to committee. So that's the idea here, just from a process. And so why do we have to be careful with capital budgeting? And the reason we have to be careful is because there's a lot of risk when we start to spend money. No matter what we decide in these models, we have to remember that our outcome is uncertain. If we're using large amounts of money to make a purchase, the decision may be difficult or impossible to reverse, and normally will involve a long-term commitment. And so something that's a very relevant example today and during these pandemic times is lease decisions or buy decisions. So one of the companies, I was working for a consulting firm before I moved over to Google, and that consulting firm just had leased 3 new offices in January, one in San Francisco, one in Oakland, and one here, really large leases that were multi-million-dollar leases. And when the pandemic happened, everyone had to work from home, right? And no one knew that was going to happen, right? This is an uncertain outcome. No one knew that that was going to happen. But now there's these multi-year leases, multi-million-dollar, multi-year leases that the company couldn't get out of without paying a large penalty. And ultimately, was a very difficult problem to reverse, right? They'd have to either pay a penalty, and then if they do pay the penalty, they don't know when to get back into the lease, right? And so many, many companies, restaurants are going through that right now. It's very difficult, but you can't predict the future. So whenever we're making these decisions, there's more than monetary considerations, but we have to be very careful assessing risk. And we bake that risk into what we call the discount rate, which we'll be going over shortly. So at the end of the day, it's actually relatively, I want to keep it simple. Always try to keep it simple. Cash can do two things, right? We can spend it or we can bring it in, right? We get money or we can spend it. I guess we got to hold on to money too. That's also kind of that's a spending and investment decision. So I'm just going to talk, we have inflows and outflows, right? It's kind of back to the cash flow statement, inflow, outflow. So what are some things we can generate money from? Well, if we just go back to our old cash flow statement from financial accounting, right? We have operating activities from our operations, investing activities. We can sell some of our investments, or financing activities. We can get money from banks or investors. That's our inflows. Our outflows are generally for acquisitions, use, and disposal when it's related to capital budgeting. So our acquisition, if we buy an item, that will be a large cash outflow. So if I go buy a building or some land, that would be an initial large cash outflow. If I have to use that land, if I'm using a lease, or if there's something that's called a usage-based contract, like a lot of these cloud contracts, or I think, what are some other good examples? Let's say, even if you think, you can even think of like food, employees, electricity, any of those things that we use, that will be outflows, right? As we use a hourly resource, we have to pay them. As we use electricity, we have to pay them. Disposal, if we sell products, or we sell if we buy a piece of land and sell an old building that was on it, or sell the materials, that could be a cash inflow, right? Or it could also be a cash outflow if maybe we have to do some kind of renovation, or there has to be some kind of compliance issue around it. So all of these ideas are cash outflows and inflows, and these are just some examples, right? But we're going to have a lot more. So